If you have ever wondered how to go beyond the simple calls and puts and really leverage the power of the options to create strategic trades, then stick around. Hey traders, welcome back to the Quant Academy. I'm your host, Frank Sarjokian, and today we are leveling up. We have covered the basics of the options, implied volatility, and even volatility skew. But now it's time to dive into the advanced options strategies that professional traders use to maximize profits and manage risk like a pro. We will explore multi-leg strategies, when to use them, how they work, and why they can give you an edge in different market conditions. Okay, let's dive into the world of the advanced options strategies. You might ask, why use advanced options strategies? First thing first, why go advanced? Why not just stick with the buying calls and puts? Well, simple options trade can work, but they often come with a high risk and low flexibility. Advanced strategies allows you to fine-tune your risk and reward ratio, profit in the different market conditions, not just up or down, take advantage of the volatility shifts, and generate income constantly. These strategies aren't about gambling. They are about structuring the trades where the probability are in your favor. In this video, we are going to talk about 4 different advanced strategies. So stick around. Okay, the first strategy is credit spread. Let's start with one of my favorites, the credit spread. This is a two-leg strategy where you sell one options and buy another options at a different strike price with the same expiration. There are two main types. Bull put spread. Sell a put at a higher strike, buy a put at the lower strike. You are bullish but want to limit your risk. Bear call spread. Sell a call at the lower strike, buy a call at the higher strike. You are bearish or neutral. Why use credit spread? They collect the premium upfront like an income. Risk is capped, and you can profit even if the stock moves sideways. Great for the high IV environment where premiums are juicy. The second strategy is iron condors. An iron condor is two credit spread combined. A bear call spread on the top, a bull put spread on the bottom. You are selling options above and below the current stock price, betting the stock stays within a range. Why use iron condors? Perfect for neutral markets when you are expecting the low volatility. Premiums from both sides add up, boosting potential profit. Define risk and define rewards. Usually look for high IV rank, sell when the premiums are elevated. Aims for the IV crush. The third strategy is calendar spread. Let's mix things up with the calendar spread. This strategy buys and sells options at the same strike price but with the different expiration dates. Longer dated options you buy this, and the shorter dated options you sell this. Why use calendar spread? The calendar spread is good for profit from time decay on the short options and benefits from the IV increasing in the long options. Great for the neutral to slightly directional trades. Calendars works best when the IV is low because longer term options are cheaper relative to the short term ones. And last strategy, ratio spreads. Now let's go a bit more aggressive with the ratio spreads. This is where you buy one options and sell two or more at a different strike price. For example, buy one call at $100 strike price and sell two calls at $105 strike price. Why use ratio spreads? Great for moderate directional bias. You collect extra premium by selling more options than you buy. Risk is limited if they are structured properly, but can be unlimited in some setups, so be cautious. These work well when the IV is high at the strikes you are selling. Okay, let's wrap up with some pro tips. For using advanced strategies, always consider IV environments. Use credit spreads and iron condors when the IV is high. Use the calendars with the IV is low. Match the strategies to the market conditions. For the trading market, use the credit spreads or ratio spreads. For the sideways market, go for iron condors or calendar spreads. Manage your risk. Multi-leg strategies limit losses, but only if you size your positions correctly. And the last suggestion for you guys, paper trading first. Get familiar with how these strategies behave in the real time, especially as the IV changes. That's a wrap up for today's video. Advanced options trade strategies can maximize your profit and control your risk, but they are required planning and understanding the moving parts. If these help you level up your options game, subscribe to the Quant Academy and hit that like button. Got any questions or want me to cover the specific strategies in deep? Drop a comment. I'm always here to help. Until next time, trade smart, manage your risk, and keep learning.